Hi everyone and welcome to this week's webinar. We're at a remote location today, so apologies if there's any issues with the sound. If there is, we'll reconnect as soon as possible. So this week, what we are looking to run through is how to maximise your returns with a mortgage. So we've done a lot of work on this over the years. The clever investors, what they would do is they will simply invest as much as they can across a broad spectrum of properties and use banks' money. At the moment, we're still getting, and we have been for the last, good, I'd say 10 years, really low rate interest rate, which has meant cheap money. So the more you borrow, the more your returns are, and we'll come to a model a bit later on and show you that. So without further ado, let's press on. First of all, one thing we say to all clients is ensure that your funding is secure. What we have is we have a number of calls in on a daily basis. We probably get in the region of 800 to 900 inquiries a month come through our door. And I would say 80% of them haven't secured any form of funding. What they do first is they typically try and find the properties first and then secure the funding. And then out of the people that have then go away and try and secure funding, quite a lot come back and say actually they realise they can't, so they can't move ahead. So what we say to everyone is go and speak to a mortgage broker first. We can help out with that, but speak to a mortgage broker first and ensure that you have the option of getting the funding. That's the first thing. And by speaking to a mortgage broker, it's 15 minutes. It would take 15-minute chat for him or her to say, yes, you've got the potential to get a mortgage. That's all you need to start off with, the potential of getting a mortgage. So as we say, securing the services of a mortgage advisor is purely sensible. That is something that you should do from day one. And if you don't know anyone, again, we have an independent mortgage advisor that we can put you in touch with. That to us is the first step when entering the buy-to-let market. Because if you do it the other way around, you may go and find a property, you've spent hours of research, you've read brochures, you've done your due diligence. Some people have even been up to the site and they go and speak to a mortgage broker, they can't get funding, and it's just been a pure waste of their time. So as I say, it's really imperative that you get the funding first. Once you've got that, we can then press on. Importantly as well, there are a number of mortgage brokers who actually haven't dealt with buy-to-let or haven't dealt with off-plan properties or haven't dealt with student properties before. And the issue that we have is we had one recently where a client wanted to move on and their mortgage broker just said, I don't understand it, so I can't give you a mortgage. Now, to me, that's crazy that person, again, he was newly qualified and he just didn't understand the market. We had to then refer this client to a new broker. But because he didn't understand the market, then that's it. It actually puts the client off. So go to a mortgage broker who's had a lot of experience, at least 10, 15 years experience, and can then come in and help you with what you need. A lack of knowledge from their part can actually cause declined offerings. So, for example, if you start to proceed with a particular mortgage broker and your mortgage gets declined, actually sometimes that can be due to the fault of the mortgage broker. They've not done their due diligence properly, or they've not filled in forms properly, or they simply don't have the information. So it's key that you actually have a mortgage broker who is fully independent, because once one mortgage has been rejected, that will go on your file, and that's something that you don't want. In regards to what you should be talking to your mortgage broker about, it's got to be independent. So many companies now supply a mortgage broker in-house. The problem is that mortgage broker has got an ulterior motive, because it's basically you scratch my back, I scratch yours, and they're going to want to push their own product. So we always say go to an independent mortgage broker. So there's various mortgage brokers that we can put you in touch with. We don't have any kickbacks off them. That's important as well. And companies have to be transparent with this. You should be asking, if anyone recommends you to a mortgage broker, you should be asking, are there any kickbacks? So for example, if the mortgage broker gets the deal through, does the company get a kickback from that? If the answer is yes, then there is some form of collusion. That is a big no-no. You want an independent mortgage broker. Also, you want to find out their charges. You want to find out their commission rates, because so many mortgage brokers will say, oh, I don't make anything up front, but they're making a lot on the back end. So find out from day one, what are their charges for actually being processed, or actually them getting a mortgage for you. Again, like we said, are they independent? They have to be independent from any project that you're looking to potentially go for. And also time frame. So many people think they can sort of phone up today and within the next 5 days there'll be money in their account to spend. It doesn't work like that. There's a number of checks that goes through potentially on you, the individual, a number of checks that they then do on the actual project. It may be the case that they can do a project valuation off a CML form. It may be the fact that they have to actually go in and they send a survey team or an individual out to go and survey the development, and they then put a valuation on that, and they will give you a percentage of that particular valuation. Sometimes a valuation may get downgraded. So what happens then? All these questions you need to speak to your independent mortgage broker about. In terms of what we feel is best for every individual if they can get a mortgage, and we understand some people don't want to get a mortgage, we get that, but if you have the capability of getting a mortgage, there is so much more potential. Not only can you buy more than one property, typically, for example, if you have 200,000, rather than getting one, you could potentially get 3 to 4. Suddenly you've got so much more income coming in, but it also means that you actually make far more percentage on the money invested. So first of all, the getting a mortgage enables you to build a portfolio to maximize the returns on your cash, and we'll go through an actual model and an example of that in a minute. It enables you to put down as little as possible. When you invest in the stock market, for example, let's say you had £50,000 to invest. When you invest in the stock market and your gains are 5 to 6%, you make 5 to 6% on your 50,000. That's it. There's no getting around it. You put in 50,000, you make 5 to 6%, and that's on your 50,000. When you get a mortgage, it's different. What happens is you actually make the 5 to 6% on the 200,000 income-wise. Then you actually take out your mortgage, whatever your mortgage costs, and you've made the profit on that. But because you've leveraged an extra 150,000, if the property increases or has the same income as the stock market, you've still made your 5-6% on your 50,000, but you've also made 5-6% on your mortgaged amount of the 150 minus the actual mortgage itself. So let's say round figures, the mortgage is 3% and you're getting in 6%. There's 3% extra being made on £150,000 that you've actually borrowed. You've not had in the bank. You've borrowed it from the bank, which you cannot do with the stock. If you go to a bank and say you want to borrow money to put into stocks, the chances are they're going to reject you. Also, importantly, when you make growth on a stock, if you make growth on a stock of, let's say again 5-6%, you make it on the 50,000. If you make growth on the property of 5-6%, you actually make growth on the whole 200,000 rather than just the 50. So there's lots of benefits of that. So again, buying with a mortgage enables you to put down as little as possible, as long as the returns are there to cover the costs of the mortgage. What we see a lot of is people, buying in the wrong areas, wrong places. They come to us and they say, I'm only getting 3%, and their mortgage is 3%, 4%. So actually they're having a negative return. That's not ideal. We want to be sure that your income model and the yield that you're getting easily outweighs what you're paying for the mortgage. There's no point in signing up for a 1-year mortgage and then hoping for the best in years 2 and 3. It suddenly goes variable rate and it goes up to 4.5%. If you can get a low rate now, fix it in for as long as you feel fit. With the extra income, what people are doing is they're building up portfolios. So the extra income that you're getting, you can then add another property over the next sort of 18 months or so. Importantly, it can also subsidize your regular income, whether that be work, pension. Importantly as well, you can pay back the loans faster with the extra income. In terms of the model, we're just coming up to that now, but what we've done here is one of our recent developments that we're advising on at the moment is producing just cash alone. It will produce round figures of, let's say, to the 10% mark. What we've done here is we've showed you what it's going to produce in terms of cash and what it's going to produce in terms of income. So what you're doing is you've got the 2 columns side by side, one with a mortgage purchase and one with a cash purchase. And in regards to the costs, obviously the operating costs remain the same either side. But of course, the only other cost that you'll have with a mortgage is the mortgage cost, but you'll still see it comes out on top. So let's head over to that now. So first of all, you'll see at the top, this is a property that we have in Liverpool at the moment. It's a fully residential development, but the way that we are letting it, it's let on like a serviced apartment. So that's why it's generating a high amount of income. It's right by the Echo Arena or what used to be called the Echo Arena. It's now the M&S Arena, but everyone knows it as the Echo Arena. And the exhibition centre there, it's right on the docks. So it's got a huge occupancy rates, hence the reason why the high return. So as you can see, you've got on the left-hand column, you've got the mortgage purchase. On the right-hand column, you've got the cash purchase, both 175,000. As you go down, the average monthly rent is obviously exactly the same, regardless of how you purchase. And that's your total income. That's based on a 68% occupancy. So on 68% occupancy, you've got exactly the same income coming in on both gross monthly operated income. We've then got the costs. So you've then got management fees, stock in the room, teas, coffees, milk every time someone goes in, housekeeping, laundry, utility bills, waste removal, taxes, all the normal costs. And we're saying your monthly operating costs on that is £1,000. Now, importantly, a lot of people said, well, if it doesn't rent, do I still have to pay the £1,000? Well, the answer is no. If you don't rent the property, just like anything, if you don't rent the property, well, you're not going to have a room to clean. You're not going to have any laundry to do. You aren't going to have any utility bills. You aren't going to have any waste removal. You're not going to have any property management fees. So actually, ironically, the fees are there simply because of the way that you're letting it out. So as you can see, the fees are the same each side. Then we come down to your net operating income. Again, both sides are the same. So you've got your income coming in at the top either side, and then you've got your operating expense, and that gives you a net operating income of 20,528.96 either side. Now this is where it gets interesting. As you go into the mortgage side on the left, you put down 43,750 in cash. The rest you've borrowed. Now we've just put a round figure here of 4%, paying interest only. Some people can go with the actual repayment side, but chances are you could get less than 4% if you had the right broker, but let's go with 4%. So you're going to have extra costs on the mortgage purchase. The extra cost that you're going to have is an extra £5,250 per year. So you've got your operating cost that we said, which is 12,413, but you've got an extra cost of 5,250 with a mortgage. But as you see, as you go down to the mortgage purchase and the cash purchase, what you see is, despite the fact that you're paying an extra 5,250 because you're paying the mortgage back, your actual cash on cash return, because you've actually only put in 43,000, your cash on cash return is over 34%, nearly 35% when purchasing with a mortgage, or 11.73% with cash. Now that's a huge difference. Now imagine that you bought 3 of these because you have the cash to buy 3 with a mortgage. So suddenly that's a huge return that you're getting year on year based on your cash. So 34%. So you're literally making over 3 times as much, or pretty much 3 times as much, just by the fact that you've purchased on a mortgage. So what we say to everyone is, before you actually take the plunge and purchase something, as I say, we probably have 60, 70 people buy with cash. But what we say to everyone is, explore the mortgage option. There are so many options out there, and you'd be surprised. You can make 3 times as much in cases like this. So as I say, the percentage return on investment is larger the less you put down, because you're judging it on the return in relation to the cash you put down. After all costs, those that are putting down, as I say, the 25%, they've got a return on investment of 35%. Compare this with the 12% return if you're using all cash. Again, although the annual return is less, you've actually put down less. So again, like I said, that enables you to explore the option of actually doing 2 or 3. Suddenly, if you did 3 like that, you'll be making 3 times as much on all 3 of those properties. So what we say to everyone is, to summarize, is explore the mortgage option. We feel that option can actually increase dramatically the returns that you're getting. And importantly, as I say, get that first. Before we even start looking at developments, get those answers first. And if you need us to put you in touch with independent mortgage brokers, we can do that research for you. But please do make sure they're independent. Many people go to their bank and they say, oh, you know what, my bank know me, so I'm going to go there. Your bank, 9 times out of 10, won't give you the best rates. And if your bank is the best rate, your mortgage broker will find that, and you'll still be able to get that anyway. However, more often than not, your bank isn't the best rate. So in terms of next steps, you should have a speech bubble where you can ask any questions, which I'll come to in a minute. But if you want to contact us about anything, in regards to either this particular development or in regards to mortgage brokers, or in regards to just running through this in more detail. If some of you haven't understood the concept as well as you'd like, and you'd like to one of the brokers or myself to run through it personally, no problem. Feel free. You can give us a call on that number below, or you can contact us on the client.care email, no problem. Or you can ask questions here, and I'll get one of the brokers to give you a call. So we've got some questions coming through already. Can I have this sheet in Excel if possible? No problem at all. I'll get that sent out to you straight away. If you actually email client care, as you see on that email there, or on that slide, if you email client care, they will be able to get that out to you today. If you don't email client care, don't worry. I am back in the office a bit later on this afternoon, and I will get that over to you, no problem. You forgot stamp duty, brokers, fees. Correct. Yeah, in regards to the fees, yeah, that's standard on any buy-to-let. We are talking, but again, in terms of stamp duty, broker and solicitor fees, that's a one-off payment. That isn't an annual payment. We are taking this as what you will have on a year-to-year basis. So yes, you are right. Don't forget, you will have stamp duty, broker fees, solicitor fees. But this particular scenario, we were showing you what you can get on a year-to-year return. Those stamp duty fees, broker fees, solicitor fees are all one-off fees that you will have to take into consideration on any buy-to-let, regardless of what you buy, where you buy. But yeah, good point. Always take that into consideration. I have one here. The property that I'm looking into is an off-plan investment completing Q4 2020. Is it too early to apply for a mortgage? And my circumstances by then might have changed. What's the best course of action? Well, first of all, if you do have a project which is a long way off, before I even put a deposit down on that, I would have certainly still gone to my mortgage broker and said, look, in principle, could I get a mortgage based on my circumstances? I would then have done certain research on the development. If you've got developments which have things like ground rent over a certain percentage, for example, there are some ground rents out there, which double every 10 years. Mortgage companies don't like that. You have some ground rents there which are over 0.1% of the purchase price. Again, mortgage companies don't like that. So I would have done certain research on that, and that's something that we do as a company to make sure that our clients aren't having those issues. Again, like you said, we can't predict what's going to happen in the future. Typically, the worst case scenario is if your personal circumstances change. So what I always will then try and do for clients, it can't always happen. What we try and do is get what's called reassignable contracts. So if we feel that there's a development that's a long way off, because people's personal circumstances do change, we try and get what's called reassignable contracts, which means that if your circumstances change and you can't suddenly get a mortgage, we, of course, will be able to sell that property for you on your behalf. Next question. How easy is it to get a mortgage if you are non-UK resident, and what are the typical rates? Okay, good question. So the typical rates are higher for non-UK residents. However, it isn't a no-no. We have 60% of our clients are overseas, and a lot of those do get mortgages. It's just a case of finding, again, the right broker who is experienced in that and can make sure that that's something that they can achieve. Again, it all does come back to your personal circumstances. What they do is the reason that they charge more interest is simply because of the fact that they feel less secure if you're overseas. What they say is, if you're based in the UK, they feel that you're more likely to pay your mortgage if it goes into negative equity, because potentially you have your own property and you don't want that on your record in the UK that you've actually just given something back to the bank. However, if you're based overseas, their protection is less. If something went into negative equity, let's go back to 2008, 2009, when some people were in, they bought a £200,000 property and they lost 30,000 overnight, for example, then typically people could have just handed in the keys and been better off. If you're overseas, you're more likely to hand in your keys. So that's why the banks will charge you more percentage by being overseas, but it isn't a no. Okay, I've got here, I'm purchasing a property, a buy-to-let property via a limited company. an SPV created for this purchase. I'm also the contractor. Is the mortgage based on my earnings? Therefore, and how can I make how can I make this on a company in order to maximize the mortgages? Could I get my buy-to-let properties? Okay, so a few questions in there. Okay, again, it all goes back to you've got to speak to a qualified mortgage broker and run through exactly what you're trying to achieve with that. I would always say there's a number of people. If you're setting up a company, there's 2 people you need to speak to, and don't take any advisor's advice in terms of the property advisor. The property advisor they have their intentions, which is to sell a property. Mortgage broker has their intentions to get you the best rate, and they make their money. But I would also say that the best 2 people to contact before purchasing a property, if you're looking to do it in an SPV, is an accountant and a mortgage broker. The accountant will give you the pros and cons of setting up an SPV, and a mortgage broker will give you the rates of purchasing in that SPV. For example, it's not just a case of you set up an SPV and no problem you can get a mortgage, because that company typically doesn't have any trading history, typically, if you've just set one up. So then it may come down to your personal earnings. You may have to be a personal guarantor for that. So there's multiple issues, again, not insurmountable issues, but it's things that you will have to look at prior to making any purchase. So I would speak to 2 people in that. It's when you set up an SPV, that's the mortgage broker and, importantly, the accountant. Got one here. Do I think Brexit will make mortgage treatment of EEA residents like international mortgages on higher rates? Potentially, yes. Again, there are so many variables going on. I'm sure you saw last night there were 8 indicative votes which all got rejected. So it's pretty tough to know what's happening. But look, let's be realistic. Regardless of what you read in the papers, UK needs EU trade and EU needs UK trade. That's the reality about it. Regardless of this gamesmanship that we see on a day-to-day basis, the EU are trying to get the best deal that they can get, which is understandable, and the UK are trying to get the best deal that they can get. Now, the deal that's been come up with Theresa May's deal, whether you agree with it or you're not, that's the deal that's on the table. However, what I personally believe will happen is I think that there are so many people against that particular deal. I'd be very surprised if it goes through Parliament, despite the fact that yesterday she said she would resign if that deal got through. I think that's quite a weak way to try and get a deal through, but that's another thing. The fact is, in regards to the deal, even if things happen on a no deal, people don't want friction, trade with friction, because if you have that, every side loses. So what I do believe that will happen is I believe that there will be an extended period in financial terms, in the financial industry, because a lot of people are relying on frictionless trade to carry on their daily lives. So I do believe that regardless of what happens, again, whether we get another long extension, I don't think you're going to have too much of an issue. But could it increase slightly due to risk? Again, potentially. UK-based SPV with foreign parent company will be acceptable for mortgage. So, okay, so the question is, will a UK-based SPV with a foreign parent company be acceptable for mortgage? Again, all about the mortgage broker. You've got that's something that a mortgage broker can answer, because the mortgage legislation changes literally not even month to month, but day to day. For example, only a couple of months ago, we're now seeing, so this project that we have that I just demonstrated in the last sort of 20 minutes or so, it's only been the last sort of 6 months or so where more and more companies and more mortgage lenders are actually open to lending on a development which is serviced apartments. Go back a few years and it would have been tough to get a mortgage on something like this. Even though it's fully residential, the fact that we're letting it through as serviced apartments, mortgage companies are always behind the times, and they've only just jumped on the back of this. So again, I'm not a qualified mortgage broker. I just know the figures in terms of what actually can make more money. But what I would also say is, in terms of drilling down questions like this, in terms of, with a UK-based SPV with a foreign parent company, that's something that a mortgage broker who has knowledge of the day-to-day understandings and the day-to-day legislative changes, they'll be the best people to speak to. And again, if you want us to put you in touch with them, no problem, we can do, no problem. Next question. How much do prices start from in this particular project, and Why is it so? How much prices start from this particular project, and why is the income yield so high? Well, prices, as I say, they did start at 160, 161, I think they were. We're probably about 55, 60% sold on the development. The ideal with the part about this development is they're all priced the same price per square foot. So it doesn't matter what apartment you get, you just have a budget, and we can fit an apartment within your budget, depending on the size. So if you've got X amount of money, we can find the right size apartment. What I would say in terms of the availability now, we're looking at the prices being from, I believe, at 199, 196 or 199, give or take. I think we have one left at 196, one at 199, and the next one 203, and then after that they start to jump up. In terms of why it's so lucrative, it's just simply location. If you look at London, for example, any location which is near either the O2 or which is near the Excel Centre makes fantastic overnight stays. Great Airbnb, booking.com, those kind of stays. The same with this. This is by the Echo Arena in Liverpool. It's right on the waterfront. If you go on booking.com now, you can book it, and you'll be able to see that actually, for example, on big nights, for example, like this boxing coming up on the 30th, this Saturday actually, or the Grand National, nights like that, it will go for £300 a night quite easily. Typically, rates will be anywhere between 60 to 100 during the week, but on big nights, that's where you make your money, and that's why it can return over sort of 10, 11% if you're using cash, or 30% if you're using a mortgage. Another question, usually all buy-to-let mortgages are 25 and 75 ratio. If started new SPV and have 4 to 5 properties, will reduce this ratio like 15 to 20 and 85% bank. I don't know if that's a question or a statement, but in regards, I'll take it as a question. In regards to the buy-to-let mortgages, again, they change. Typically, yes, it's 25, 75. They want a minimum of 25. Again, it goes back to security. They feel that you're more likely going to renege on your, again, let's go back to the negative equity scenario. You're more likely to renege on a buy-to-let property than you are your home. So therefore, that's why they want more money down. You can go and get 5, 10% mortgages, put down 90% leverage on your residential property, but not on a buy-to-let. However, if you have more in your portfolio, with them, again, you'll have some clients or some companies that will want more protection because you have a number, and anything over 4, you become a portfolio investor, so they actually want more security rather than less. But some will be open to putting down less. But again, that comes back to the your mortgage lender and your mortgage broker and finding out more details through them. Another question here. I'm investing in Liverpool, and most off-plan properties require 50% deposit versus mortgage. Required minimum 25%. Therefore, it limits my cash profit maximisation. Why are they so high, in your opinion, and how do I find 25% deposits developments? Okay, I don't know what you've been investing in, but 50% is extremely high. Go back 3 or 4 years, that was the norm. But now, no, I certainly won't be putting that down. The reason being is pure and simple, they don't have the money to build. If they require 50% deposits down, it means that they're using your money to build a project. Now, whilst sometimes that's okay, what I would say is we don't recommend those. That, for me, is scary. In this current climate, it's scary because what you actually have to realize is that what if they don't build? They've got 50% of your money. They can legally use, depending on the contract, but typically out of your 50%, they can use 40%. So on a £200,000 property, if you put down 100,000, they can use 80,000 of that to build. And if they do a bad job and they realize actually this is costs are spiraling out of control, they'll walk away from site. And I know that's not what you want to hear, but I want to be brutally honest with you. Do not be putting down 50% deposits on big chunks. If it's things like student property, that's slightly different. But again, I would be personally paying in stage payments, but student properties are 50%. But in terms of that, in student properties, it's very rare that you'd be able to get a mortgage anyway, even on a student property, due to the fact that student property is classed as commercial and the size is typically less than 30 square meters. However, if you're putting that down on a residential property, I would say, look, let's catch up, let's speak, because there are certain concerns that I would have there. In terms of how do you find the 25%, developments. Well, we have a number of developments across the UK, and the 25% is probably the maximum. We've got developments that are 10%, 15%, and up to 25%. But again, I certainly wouldn't be going to the 50% mark. Just so if you want my email, guys, it's Christopher.Whetstone. That's WHETSTONE. So that's Christopher.Whetstone, WHETSTONE, at, and then flambardwilliams.co.uk. So Christopher.Whetstone at flambardwilliams.co.uk. I've got another question here. Could you send the availability over for the development that you showed? Yes, of course. Again, if anyone wants anything to do with that particular development at all, no problem. I can send that over. Feel free to email me. As I say, I'm back in the office a bit later on this afternoon, and I will send over any availability or any questions that you guys have about this model. I'll send that over, not a problem at all. Well, guys, sorry, I've got this. I've got another question. Didn't catch your email address. Can you please send a follow-up email from it? Of course I will. I will get an email out to everyone with my email address. And I tell you what, maybe if I type it here, it may come up on your screens. If it doesn't, I'll get an email out anyway, guys. But I've just punched that in. Let's double check that I typed that correctly. I've just sent that to everyone, so everyone should now have that. So any questions, guys, let me know. I will be sending this out to every single person, and I'll be sending my email address out, but all of you should have that now, have my email address. And I'll say any questions, just drop me a line. And I hope this has helped. Hope you've enjoyed it, and I look forward to speaking to you soon. Take care.